Well, thank you all for attending today's webinar. We've got a great one for you, as always, a very popular topic. Today, we will be talking about Social Security. This is a topic that we continue to get a lot of questions on, and rightfully so, because there are a lot of nuances to Social Security and how and when you claim your benefit. If you're married or divorced or a widow or widower, what impact does that have on your Social Security benefit? What happens if you're claiming and you decide to, you were previously married and decide to get remarried? Does that impact your benefit? So lot of different things that we're going to cover today regarding Social Security, and I appreciate all of you for sending your questions in. Great questions as always. They do help us frame the topics and what we'll go through. So again, appreciate that. And questions that we are not able to cover throughout the webinar, we've been actually covering them in future podcast episodes. So tune into the podcast and you will hear your question answered. So my name is Matt Wilson. I am the Chief Investment Officer and President here at Keen Wealth Advisors, and we hold monthly webinars on various topics throughout the year. We'll cover different things regarding financial planning and the issues that people that are transitioning from working into retirement, what are the things that they are concerned about and what questions do they have? That's what our webinars cover. We also cover the investment side of things too. I'll have 4 quarterly market update webinars that, we'll talk about what's going on in the financial markets and how to interpret the information that you might be hearing on the news or on the television, and what our outlook is as well. So encourage you all to tune in to our webinar series throughout the year, because we will cover different topics for those that are in different stages of retirement. And our objective here is, one, to educate. We really do want to help people be better educated on the decisions that they are facing, because we think that the better that everyone understands the choices that they have, the better it is for everyone, whether it's you are a do-it-yourself type person or you're someone who is looking to engage a financial planning firm such as Keen Wealth Advisors, or current client. These webinars are educational in nature. So I encourage you all to submit your questions as we go throughout today's webinar, because we do want to address the issues and questions that you have. As I mentioned, we have a podcast as well. You can find all of our podcast episodes and future episodes on Keen Wealth Advisors on our website under the Retirement Resources tab. There you'll see the webinar replays. You've got many years of that to go through, and various rule changes and different topics that we've covered. And we also have a popular blog too. So again, check that out, keenwealthadvisors.com under the Retirement Resources tab. Also, our founder and CEO, Mr. Keen, he is a Amazon best-selling author. He's got his 2nd edition of his best-selling book out, Keen on Retirement, Engineering the Second Half of Your Life. If you don't have a copy of that book, or if you'd like a copy of that book, please shoot me an email. Happy to send out a personalized copy to you. Or if you do have one and you'd like us to send it to someone else, we're happy to do that. My email, mwilson@keenwealthadvisors.com, and we will get that taken care of for you. And then lastly, we have our YouTube channel up and running. Encourage you all to check that out as well and subscribe. YouTube.com/Keen Wealth Advisors is the URL. We also have links on our website directly to it. We will have episodes of our podcast in video form published there very soon. So there'll be content on the YouTube channel that you will only find on YouTube. So if you could all subscribe to that, you will get those updates as they are released. All right, now let's talk about Social Security and everything that you need to know. This is we're going to cover this from a high level, a macro level, as I like to say. And when you have very specific personalized questions, we're definitely happy to answer those offline. If you're a client, of course, we'll cover that in any of communication that you would like, whether it's an in-person meeting or over the phone or email. Definitely want to get those answers to you. And if you're not a client, feel free. Just again, you can shoot me an email or reach out to anyone on our team, and we'll happily have a conversation with you and answer those questions that you might have. But today we're going to cover, will Social Security be there for me? One of the most common questions we get. And all right, well, how is it calculated? How much should I expect to receive? When should I apply for benefits? That is a very, very common question. What are the maximums that I can receive? And will, Social Security, is it enough? So this, this question, will Social Security be there for me? I mean, it's a major concern for a lot of folks that are in retirement, already claiming Social Security, folks that are approaching retirement, because it has been a constant conversation among the politicians, but also in the media, that the Social Security trust funds are running out of money. And so what does that mean? Well, what happens is, Social Security is funded through the payroll tax, the FICA tax. There's two components to that. Majority of it is for Social Security, and then a small piece of it is for Medicare. And when you're employed by a company, you pay in half of the payroll tax, and your employer matches that, and they pay the other half. And that is what has gotten the Social Security trust funds to this point. The excess that's been collected over the years are held in a trust fund, and they are invested in U.S. Treasuries, which essentially means the government just they put the money in there, they earn some interest. Well, then the government then gets those funds to the Treasury Department to do whatever they want with. So it is in there in U.S. Treasuries. So it's part of the debt. When you hear the national debt and you hear how much is owed to other countries, well, large portion of it is owed to us, the taxpayer, because it is the Social Security trust funds. As you can see, there are $2.8 trillion in the trust funds as of December 31st of 2023. And 2023 saw a slight decline. So we have the numbers here. This is from the trustees report. So every year the trustees come out with here's everything that came in and everything that went out. They do a full accounting of it, and there's a slight decrease in assets. And based on the trend, so the trustees kind of project out, well, where do they see the trust funds at certain points in the future? And because they don't want the trust funds to last indefinitely. That's not the purpose of building up an excess. What they want the trust funds, when they project it out, is they look out about 75 years, and they want to say, okay, well, is there a shortfall, or will there be an excess? Helps them determine what maybe some solutions would be if there's a shortfall. So right now, the trust funds, based on current population and projected workforce and people paying in through the payroll tax, by 2035, the trust funds would be exhausted, and the future workforce is projected to cover 83% of the projected outflows. So I have this graph over here, and again, this just comes directly from Social Security's website, ssa.gov, and you can see the expenditures, the costs. So there was a excess. This is where they were bringing in more than they were paying out, and then by 2008, 2009, you can see that flipped over, and now there is a deficit. So now they are spending more than they are bringing in, and this is where that projection 2035 comes in, and trust funds would be exhausted. The inflows kind of in this straight line here, and then you've got the projected cost, and there's the shortfall gap. And this has actually been improving over the years. Early on, the projections were 75%, 76% by the early 2030s. And now you're seeing years getting pushed out, the percentage increasing. And part of that is because they issue projections. They don't know exactly what the workforce is going to look like. I think they can get, they have an okay assumptions built in, but there's more people working and less people claiming than they projected. That's basically what this means when those numbers change, and it's a positive. What I will say is that there are solutions to fixing the shortfall. The trustees actually propose solutions to just allow people to understand that there are fixes to this. And some of the fixes are, well, one, they can increase the maximum income that is subject to the Social Security portion of the payroll tax. So right now, and this is for each individual, so a married couple, they would each be subject to this, but your first, call it 169,000 of income, and that's W-2 income, that's self-employment income. That does not include IRA distributions or passive income like rental properties, things like that. It's earned income, whether you own your own business or you work for somebody. That's what this applies to. And once you hit this number in earnings, then the tax, the Social Security portion of the FICA tax stops, and that's about 6.5%. And there's another portion for Medicare, about 1.5%. They're slightly less than that, but for round numbers, that drops off. So people who make more than that, they might realize that their paychecks go up at a certain point throughout the year because that Social Security tax is stopping. So they could increase that cap. That's one solution. They could raise the retirement age, what they define as the normal retirement age, which is now age 67 for individuals born in 1960 or later. It caps at age 70. You can delay it. You can claim it as early as age 62, but to receive 100% of your benefit based on their calculation, which we'll discuss how that works, that is currently age 67. They could also lower benefits for future retirees. And one way they could do that is change the inflation calculation. I could see them changing the inflation calculation. The lowering benefits by just cutting them, I don't think is something that Congress would do. They are elected officials, and anytime Social Security or Medicare is discussed, it is typically spun as a negative. So most of the politicians do not address it, and partly because, especially on the Social Security side, when the trust funds are set to run out of money in 2035, well, in the political world, that's a long time from now. There are current issues that they'd rather deal with than try and figure out a solution for something that is really not a issue until 10 years from now or 10 years plus from now. So that is not on their radar, and I don't think we'll start to hear more about it until we get closer to it. For example, there has been previous legislation that has been passed regarding Social Security, and some of the most transformative legislation was in the early 80s. And at that point, Social Security was completely tax-free for everybody. At that point, the trust funds were set to run out of money in 6 months. So this is not the first time that the trust funds have been, in a depletion or in a deficit. They were set to run out of money in 6 months. That's how long they waited until making a decision. And they changed how Social Security is taxed, which I'll show you how that currently works. And then they also increased the full retirement age, or the normal retirement age, from age 65 to age 67. That law was passed in the early 80s. And it took a long time for the tax was implemented right away, but for the increase in full retirement age, that was phased in over many decades. So I see, I see a combination of all of these as solutions. I really do not believe that future retirees are going to see benefits cut. So what you're receiving, I don't think is going to change. Where I mentioned about the cost of living, well, let's say the inflation is, as defined by the government, is currently 3% as a current number. Let's just say that's what it is. And they will come out with a new inflation number here in October, November is when that's released, what the benefits will be for 2025. They could change how that's calculated and make it a smaller cost of living increase. So your future increases could be lower, but not necessarily changing your current amount that you're getting deposited. I think they would be more apt to do that because that's a future thing that you're less likely to see, versus a reduction in benefits is very in your face and usually not favorable for elected officials. So, all right, well, moving on to how much you can expect to receive. Well, there's several things that go into it. I mean, it's how much did you earned and paid into it, and age you apply, and if you're married or not. I mean, that is a factor too. So at age 62 is when you are eligible for a reduced benefit. There's ages you could get it sooner if if you're disabled and other things, but for just the most filers, age 62 is the earliest. And what Social Security uses is your 35 highest years of earnings. And then they come up with a formula, the calculation of your average indexed monthly earnings. So if you go to SSA.gov and you pull up your statement, they will show your 35 highest years. Actually, they'll show all of the years that you've paid into the Social Security system, all the payroll tax that's been withheld. And they take those tax withholdings that you've paid in, and then they index them, or they inflate them. They want to bring it to today's dollar. So something that you paid in 35 years ago is going to be much smaller from a dollar amount, but they want to make sure that they're using a true correct calculation. So they index them, and then they come up with this monthly average. And then they have a formula that has kind of 3 different pieces to it that they run through your average monthly to determine what your benefit will be at full retirement age. And then they will have cost of living adjustments too, built in as going forward. So here's an example of how this works. So we've got someone born in 1962, so they are turning 62 in 2024. And they have paid in the maximum amount every year since the age of 22. So I would say that person's probably a high earner, because at age 22, if you were paying in the maximum amount, you were probably doing pretty good. I mean, 168,000, 169,000 is the max today. That's where your earnings are capped. So back then, the number was less because it was, you look back at what the inflationary environment has done to earnings since then. But at 22, if you were capping it out, you were doing pretty good. So the averaged index monthly earnings for them comes out to 13,100. So again, that's, they show you how all this is calculated for you if you go to ssa.gov. They take this 13,100 and then they run it through this formula. So they take the first, this is for everybody. So whatever your number is, if it's 10,000, if it's, 8,000, whatever, the first $1,174 of this is multiplied by 0.9. And then the portion between 7,778 and 1,174. So that's, when you've capped it out, when you're above that, that's 5,904. That's multiplied by 0.32. And then the amount over $7,078 is then taxed at 0.15. So you can see we take 13.1 and run it through here. That gives us their benefit at age 67, which would be equivalent to 100% of their benefit. They call that your primary insurance amount. So if they claim it at 62, it's going to be reduced. If they wait to age 70, that number will go up. And if they continue to work and replace one of these years, again, it's the 35 highest years. They have 40 years. They've maximized it every single year. But when they rerun it every year just to make sure that they're using all of your income and giving you the highest benefit. But the reason I show this formula, because I want to point out that it's skewed towards if you don't max it out, because people might say, well, I haven't maxed it out for 35 years. What would my benefit be? And again, ssa.gov will show you the calculation. But the earnings that you have that are lower are getting the highest percentage of the calculation. So when someone doesn't max it out or when they have lower earnings, they're still getting this same 90% of their first, call it $1,200 is part of their formula. And then roughly a third of the portion over that is then included. And then once because if you look here, 13,100 is their maximum. Well, it's like half of it, it's actually less than half of it, but around half of it only counts as 15% towards the formula. So they've maxed it out, but that additional earnings is really not skewed to help them as much as your lower earnings are. So I hope that makes sense. But yeah, it's when someone has earned half of what someone else has, it doesn't mean their benefits half is basically what what I want to point out there. So question that we commonly receive is, should I claim it at 62 or should I wait till age 70? And there's a lot of facets to providing an answer to that question. But I do want to walk through some of the thought process around Social Security claiming and whether you're going to claim early or delay, because it will be reduced if you claim early. And if you have taxes withheld from it, of course, you'll receive less. Your Medicare premium, if you're age 65 and you're on Medicare, will also be reduced or deducted from from your Social Security check when you are receiving it. So when should you apply? Well, I like to say that if you tell us your date of death, we can tell you the exact time to apply. But since we don't know that, we have to come up with some educated kind of assumptions to provide some analysis. And these will, they're going to be different for everybody. First and foremost, what is your health status? Which kind of ties into your life expectancy, your need for income, whether or not you plan to work, and then if you're married or if you have what they would call dependent children. So under the age of 18, young children, survivor needs too, because, there's benefits that they're eligible for as well. So, and your spouse if you're married. So let's kind of talk through some of this stuff because, health status, life expectancy, I mean, that's a big factor. But that's not just the end all be all, because you might, yes, be married, but your spouse could have a very good benefit themselves. And if you don't think you're going to live very long, then maybe you should take it, because their survivor benefit really isn't going to be impacted much by you not taking it. Because if you are, uh, uh, less healthy, or if you have a terminal illness, but you were the primary earner, if you claim it just because you may not think that you're going to live very long and you want to receive something, that's a reduced benefit, and that's going to impact your survivor benefit. So it may be better for you not to claim it, because your survivor could have a much better benefit had you not claimed it. So again, it's not an easy, here's exactly what you do type answer. The other part of that, your need for income. Do you have assets saved in retirement plans? 401ks, 403bs, traditional IRAs, Roth IRAs, things of that nature. Money saved in what we would define as after-tax accounts. Those are accounts that are outside of those retirement plans. You've already paid taxes on them. Maybe it's just cash in the bank earning some interest, or invest in CDs, or you have it invested in in stocks and bonds, mutual funds, things like that. That can have an impact on whether you claim Social Security or not. One of the common strategies that we look at is, well, Social Security is taxed as income. I'll show you that formula here shortly. But if you have less income, especially taxable income, depending on how your assets are structured, then it may make sense to delay Social Security so that you have less taxable income and better opportunity for Roth conversions or ACA planning. If you're not 65 and you're not on Medicare yet, you could qualify for a subsidy on the healthcare exchanges by having less income. So all different kind of factors for every single person when it comes to when you should claim. But just let's talk through the different pieces to it, because you have your full retirement age. The government really likes their acronyms. FRA, full retirement age, which at your FRA is when you're eligible for your PIA, which is your primary insurance amount. That's 100% of your benefit. You can see here how that has changed over the years. Full retirement age 66, based on your year of birth, and then once you hit 1960 or later is now age 67. And that's the current formula for everyone, age 67. If you claim early, well, if your full retirement age is age 66, you're going to receive 75% of your benefit at age 62. If your full retirement age is age 67, you're going to receive 70% of your benefit. And you can see each year you wait, this is how much your benefit increases to 100%. So the reduction by claiming early. And the way it's calculated is it's calculated monthly. So you don't have to wait to your birthday or birth month to claim. Like, that's a question we get is, okay, well, if my full retirement age is age 66 and I claim at 62, if I claim it at 62 in 11 months, is it still 75%? And no, it's like 5/12 per month is kind of the increase that you get there. But you also get a benefit by waiting, a delayed credit, as they call it. So full retirement age, 100% of your benefit. Here's age 66. Here's age 67, and that's increasing. So 66, your full retirement age. Age 70, you will receive 132% of your benefit. If full retirement age is age 67, you will receive 124% of your benefit. So you can see the annual increases. And again, this works the same way. Every single month you delay, you do receive a credit for delaying. So it's not dependent upon you reaching your birthday or birth month. Yes, as I mentioned, ssa.gov, if you can go on there, you can find your benefit, how it's calculated, a lot of different calculators and things like that. And you can estimate future benefits, a lot of things that you can do on the Social Security website. So I encourage you all to log into that if you have not done so. You do want to make sure that you can get into that, because one of the ways that you can turn on your benefit is just through the government website. They do have physical locations that you can go visit. You can also call them. There is typically long hold times on the phone, but you can do it various ways. And we talk a lot about in our planning delaying it to age 70. And it's not because we think everyone should just delay it. We just want to look at, from a planning standpoint, if you delay it, what impact does that have on your overall financial plan? Because we're factoring in your other assets, what your long-term goals and objectives are, what you think life expectancy looks like. That's for you and your spouse. We want to factor all of that in, and we can run an analysis to come up with an answer that is looking at more than just one piece of it. Because when you look at Social Security in a vacuum all by itself, that typically isn't going to give you the correct answer of when to claim it. You've got to look at it as a holistic piece to your plan. How is this going to impact everything? My taxes, all of that. You also, when you delay it, of course, you get your cost of living increases too, in addition to the delayed credit. So that is all kind of factored in here. And this is what this displays. Like if you wait to age 70 to claim it, you get 124%. This is based on someone who has age 67 as their full retirement age, and $3,000 is their benefit at age 67. If they delay it to age 70, just from a delayed credit standpoint, they would receive $3,720 a month. And then when you factor in the cost of living increases, this is just based on a 2% cost of living increase. You've got the increase from $3,700 to almost $4,400. You see how that compounds. I mean, it's like, wow, that's a big difference. I mean, at first you might, $700 a month. Well, it's actually $1,400 a month, or just slightly less than that is what it would be based on that, hypothetical cost of living increase. So it is it does add up over time. And you can see as the older you get, the difference or the delta between claiming at age 67 and age 70, how that changes. Delaying it is, it is based on how long you live, because that's how we can back into what your lifetime benefit will be. And again, no one knows the answer to that. So there's definitely some educated assumptions that have to be built into the plan. But the nice thing is, you can always, if you're retired and eligible at age 62 and you decide to delay it, it's a constant conversation that we're having with everyone, because we want to make sure that that's still the right decision, because you can always turn it on. So even though the decision at your age of eligibility is to delay it, doesn't mean it has to stay that way. You don't have to tell Social Security anything until you decide to begin it or start claiming. That's the only thing you have to do. So you just do nothing if you decide to delay it, is how that works. Now, how is Social Security taxed? Well, there's a couple of things to be aware of. As I mentioned earlier, that if you're still working, then claiming it early typically does not make sense for most people. And here's why: because they have an earnings test. And what they do is they look at how much you make. And again, this is all W-2 earned income. So self-employment income or W-2 income. And for every $2 that you earn over $22,320, $1 of Social Security benefits will be withheld. So this does not apply to IRA distributions. Roth conversions, things like that. That does not apply to this, only earned income. So if you claim it at age 62 and then you still continue to work and have earned income, if it's more than this, you're going to have to pay back some of your Social Security benefit. And they will find out on your tax return, and then they'll let you know that you might have to, pay some of that back. In situations that's happened, what I've heard Social Security has typically done is they just withhold more out of your future checks if you'd like that, instead of just making you pay, write a big check to the IRS or to the Social Security Administration. It just depends on how much you owe and everything else and how you'd like to handle that. If you decide to claim early at age 62, and then you get an offer to work, you have the first 12 months where you can just pay it all back and act like you never started it. That is allowed. If you're past that 12-month window, so let's say you claim at age 62 and then at age 64, you get an offer and it's a lot of money and you don't want to pass up on it. You've still taken Social Security early. You still locked in your reduced benefit, but you can tell Social Security to stop sending you the money, because if all you're going to do is have to pay it back, then it may not be beneficial for you to receive it. So those are some options that you have if you find yourself having to stop it, or if you're paying it back all the time because you are earning too much. Here's how Social Security is taxed. So they have a formula called provisional income, and what they do is they take your adjusted gross income plus 1/2 of your Social Security benefit plus any tax exempt interest that you could have received. So tax exempt interest, that's interest that you receive from government municipalities. So we call those muni bonds or municipal bonds, and those are held outside of your retirement accounts, and they pay interest typically at a much lower rate than what you would receive in a CD or from a government treasury, but they are exempt from federal tax and can be exempt from state tax if it's a bond that's in the state that you live in. Again, those are for investments that are outside of your retirement accounts, and they add that back in because if you have a large amount of tax exempt income, they want to make sure that you're still paying your fair share, so to speak, in this calculation. You can see the limits are pretty low. Provisional income. So this formula, if you're married and the amount is over 44,000, then 85% of your Social Security benefit counts as income. So it's not taxed as at 85%. It's just 85% of it flows through to your tax return as income, and then you pay whatever percentage tax that you owe based on what bracket that you're in. If that calculation is less than 32,000, then none of your Social Security is subject to tax. And you can see how if you're single, the threshold's there, and if you're married filing separately, they basically just say any amount over 0 is subject to that 85% pass through to your tax return. So for most people, the way to think about it is that you will receive 15% of your Social Security tax free, 85% of it will count as income. So I mentioned earlier, one of the things that we look at is if you do delay, then what other things that we can do from a planning standpoint, because your income is less. Because by claiming it, it's we'll look at what the income calculation is, but by claiming it, it's typically going to have some impact on your tax return. And one of the main things we look at is Roth conversions, because if you have less income, then there could be an opportunity to convert money from a traditional IRA to a Roth IRA. So, taking money out of your tax deferred account, paying the tax, and then putting it in a tax free account, something that we do commonly for folks. Medicare too will come out of your Social Security check if you're 65 and on Medicare. Currently, the Part B premium is $174.70. You can see too kind of what percentage of Part B is makes up your percentage of your benefit based on a $2,600. So here's what that is. John's primary insurance amount is $2,000. Jane's is $800. If Jane applies at her full retirement age, her benefit will be $1,000. Right? Okay, well, how does that work? Well, so Jane paid, she worked, she qualified for Social Security. You got to pay in for 10 years or 40 quarters through the payroll tax, and her benefit on her own earnings record was $800. If she had not paid in at all or did not meet the 10-year or 40 quarter earnings threshold, then she would still receive the spousal benefit based on her husband, John, and half of his amount. And she's eligible for this $1,000 benefit at her full retirement age, which is 50% of his. That benefit does not increase. So you do not get delayed credits on your spousal benefit by delaying to age 70. It's 67 is the maximum. And the spouse must be at least 62 for reduced benefit or full retirement age for the full benefit. So they can still, like the spousal benefit can be claimed at age 62 by the spouse, and they will receive a lower amount. They will receive a delayed benefit, just like they would on their own. And then one of the other key things is that the primary worker must have filed for benefits. So that's an important piece of this as well. So if John was younger, then Jane would not be receiving her benefit until John is eligible to claim his benefit. She could not turn on hers or her spousal benefit sooner. She could turn on her own benefit and then switch to the spousal. But when you turn on your own, you're going to kind of lock in if it's delayed, if it's lower, you're going to lock in a lower amount. And your spousal benefit, even though it might be more dollars, still subject to this lock-in of a lower amount. As I said, it can get kind of complicated in different scenarios here on how this all works. So a few maximization strategies. Years ago, there were some different strategies that allow people to file and suspend and kind of take advantage of Social Security in different ways. A lot of that does not exist anymore. So really, it's when we look at maximizing it, it's all right. Well, how do we factor in the survivor benefit and your other assets? That's kind of the big things that go into it to maximize your lifetime benefit. And when you think about it, okay, well, if the lower earning spouse, if their primary insurance amount is more than 50% of the higher earning spouse, so their benefit that they've earned on their own is more than what the spousal benefit is, then they'll maximize it based on, if they live to average or long life, expectancies, they will maximize Social Security by both delaying it to age 70. If the lower earning spouse's primary insurance amount is less than 50%. So this is back to our original example with Jane and John. Jane doesn't get any benefit by delaying past age 67 on her spousal benefit. So a way to maximize it is for her to claim it early, and then the higher earning spouse to delay to age 70. And then, if they both live to average or long life, they're going to maximize it. But if you also factor in the survivor benefit too, that Jane would receive, should something happen to John unexpectedly, she would receive a higher survivor benefit. What about if you're widowed or divorced? What impact does that have? Well, if you're widowed or divorced, you're eligible for survivor benefits or divorced survivor benefits. And divorced spouse benefits, they can increase your monthly check. Now, there are some eligibility requirements that have to be met for this, especially when it comes to divorced spouses. But the survivor benefit, first and foremost, will depend on the age at which the deceased spouse originally claimed their benefit. So that's a key factor here. So if the spouse who passed away claimed it early, then the survivor benefit will be limited to the higher of the deceased spouse's benefit, or 82.5% of the surviving spouse's primary insurance amount. So, again, kind of to rephrase that, if the deceased spouse claimed at age 62, and let's say they pass away at age 75, and their benefit is now $2,500 a month, the surviving spouse will receive at least $2,500 a month. Like, that's the minimum. If 82.5% of his or her primary insurance amount is higher, then they're just going to continue to receive theirs. So they're always going to receive the higher of the two, is really what that boils down to. If the deceased claimed after their full retirement age, so they didn't claim at age 62, they claimed at age 70, they passed away at age 75, again, the survivor is going to receive the highest amount. They're going to receive what it was that the deceased spouse was receiving. So important to understand that. Now, when the survivor claims is also another impact here, especially depending on their age. So surviving spouse is age 60. Well, if they claim before their full retirement age, which they would be, age 60, the survivor benefit will be a fraction of the original benefit, because you can claim as a survivor at age 60. That is one of the ways you get Social Security slightly earlier, is you can claim at age 60 as a survivor. But they're going to receive a much lower benefit by claiming it early. This you see here, 71.5% of the primary insurance amount if claimed at age 60. If the survivor waits or claims after full retirement age, the survivor benefit will be equal to 100% of the original benefit. So they can delay it. You can delay the survivor benefit too. So key kind of factor there on survivor benefits. Here's an example. We've got Joe and Julie. Both are over full retirement age. Joe's benefit is $2,800. Julie's is $1,500. Joe passes. Julie notifies Social Security, and her $1,500 benefit is replaced by the $2,800 survivor benefit. So she just receives Joe's benefit of $2,800, because they're both on it. Now let's look at if they delay. So Joe's PIA is $2,800. Joe delays claiming to age 70. His benefit is 124% of $2,800, which is now just under $3,500. Joe passes. Julie's survivor benefit will now be just under $3,500. Assuming that she would wait on that survivor benefit if she was younger. You see here that note, Julie claims survivor benefit before her full retirement age, she'll get less. So if Joe passes, early, she can still delay the survivor benefit, but if she claims early, then she kind of locks in that lower amount. Here's the rules around survivor benefits. You have to be married at least 9 months. You must be at least 60 to be eligible. Survivor benefits are not available if widow or remarries before age 60. So, again, another thing to factor in there. And then there's divorced spouse survivor benefit that could be available if the marriage lasted at least 10 years. And that moves us into the divorced spouse benefits, because yes, the marriage must have lasted at least 10 years. So that's where those divorced spouse benefits do come in. And the person receiving the divorced spouse benefit, so if you're the one who if the person, the primary worker, got remarried but you didn't, you can still claim divorced spouse benefits. But as soon as you get remarried, that option goes away. The ex-spouse must be at least age 62. And if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. So that's, again, another factor there. More than one ex-spouse can receive divorced spouse benefits on the same worker's record. So if you were married, you had 4 marriages that were each 10 years and 1 month, and they were all ended in divorce, all 4 of those divorced spouses would be eligible, assuming they didn't get remarried. And this is how it works. And the benefits paid to one ex-spouse do not impact the worker or the current spouse or the other ex-spouses. So they no impact there. And then again, they do stop upon remarriage. Just if you get remarried, not the person that the work record, your previous spouse, their remarriage does not impact you. I know we talked about a ton today with Social Security, and there is a lot of situations that we're not able to cover. I mean, every person, every couple, they have unique situation, and we want to help you out and help you think through that, and also in the context of your overall financial situation. As I mentioned throughout today's webinar, it is very difficult to just answer when's the best time to take Social Security without knowing anything else about your situation. So, think through, well, what is the rest of my financial plan look like? And, we're able to help people visualize this, put all the numbers together and give you information that allows you to make an educated decision. You can talk to Social Security Administration, and they'll walk through all the options you have, but they don't know. They're not financial planners, and they're not going to ask you, nor do they want to have the information regarding the rest of your financial life. So they're not able to answer, well, when should I take it? They're not going to be able to tell you. They'll just tell you, well, if you take it now versus if you're eligible, if you take it now versus delaying, what those numbers are. They'll explain the choices, but again, not able to answer that in context of your overall financial plan, because you've got things that are coming at you, taxes, healthcare. You have required minimum distributions now for folks beginning at age 73. What type of income are my investments going to make if I do delay Social Security? I'm going to spend down my current assets. Do I want to do that? What if I keep working? How does that impact me? What if my spouse continues to work and I don't? Can I still claim Social Security? So there are, so many different questions that we can help you answer. So I encourage you all to, to reach out to us with questions that you have. I know we've got a large financial planning team, and they do have some capacity here, able to help answer questions. Also, we'll have some members from our team following up to just make sure that all your questions were answered. And if you're not a current client of Keen, to see if you'd like to sit down with one of our financial planners and go through an analysis regarding when is the best time to take Social Security and how can I maximize my benefits. Well, I appreciate everyone joining our webinar today. I encourage you to go to our website, keenwealthadvisors.com, under retirement resources. Check out our blog, podcast, and previous webinar replays. If you'd like a copy of Bill's Amazon best-selling book, please shoot me an email, mwilson@keenwealthadvisors.com. And lastly, check out our YouTube channel, continuing to add more content to that on a very regular basis. YouTube.com/@keenwealthadvisors. So again, thank you all for attending, and I appreciate everyone submitting their questions. We will do our best to get you answers to those questions, and also check out a future podcast episode where we'll be covering them. All right. Have a great rest of your day.